Right now, the world is watching the war between United States, Israel, and Iran. Oil prices have spiked to over the psychological threshold of $100, reaching $110 per barrel. Stock markets that nervous and is being trashed now. You hear the same headline everywhere. War means higher oil and falling stocks. But history tells a more nuanced story. So instead of reacting emotionally, let's look at what actually happened during the previous oil shocks and wars. One of the most famous examples is the 1973 Arab-Israeli War, which triggered the global oil embargo. Oil prices quadrupled almost overnight. The S&P 500 fell roughly 48% from 1973 to 1974. At first glance, it looks obvious. Oil shocks trash markets. But the situation is probably more complicated because at the same time, the United States economy was facing high inflation, rising interest rates, recession, so oil was only one part of the story. Another example, the 1990 to 1991 Persian Gulf War. Oil prices spiked almost 130% in a few months after Saddam Hussein invaded Kuwait. Markets dropped initially, but the interesting part is that the S&P 500 recovered quickly and rallied strongly once the war outcome became clear. Within a year, the market was already higher. Then came the 2003 invasion of Iraq. Oil uncertainty pushed markets down before the war began, but once the invasion started and uncertainty declined, stocks rallied sharply around 2003, and again, markets responded more to uncertainty resolving than to oil prices themselves. A recent paper published in Energy Economics studied nearly 50 years of oil prices and stock returns. The researchers found something surprising. Oil prices changes only appeared to predict stock returns during a small number of extreme geopolitical events. Just 4 major events drove most of the statistical relationship: the 1973 Arab-Israeli War, the 1986 OPEC oil collapse, the 1990 Gulf War, the 2003 Iraq invasion. So outside of these extreme moments, oil prices did not reliably predict stock returns. In other words, oil spikes during wars, stock falls during uncertainty, but oil itself is usually not the real driver. So the researchers also tested a simple strategy. If oil goes up, sell stocks. If oil falls, buy stocks. It sounds logical, but historically, this strategy failed to outperform buy and hold investing. Most of the time, it produced no meaningful extra return. Trying to time the market using oil prices simply did not work. So how do I think about the current situation? Very simply, I'm not selling my stocks because of geopolitical headlines. History shows that wars and oil shocks create volatility, but they also create opportunities. Some of the best long-term investments were made during moments of maximum uncertainty. So instead of panicking, I'm watching markets carefully. For some of you who might already know, I run a small Telegram community. It's for like-minded people who are already fired, or seeking to fire. There's no ads, no sponsor and causes, as far as I can try to keep them out. So it's really a small community. If you're interested, do feel free to join, and I'll put a link in the comment description itself. And hope to see you there. If you like the video, please remember to like, share and subscribe, and I'll see you in the next one. Thank you.